E10-7 says, on January 1st, 2013, ATC issued $500,000 in bonds that matured 10 years. Bonds have a stated interest rate of 10%. When the bonds were issued, the market interest rate was also 10%. The bonds pay interest once per year on December 31st. Requirement 1 is to determine the price at which the bonds were issued and the amount ATC receives at issuance, otherwise known as determine the cash proceeds. Our first goal, our first requirement is to determine the cash proceeds that we get from the bond. Well, we're not told whether or not the bond issued at 102 or 103 or 97 or 98 of face value. We're told instead what the market interest rate is and the stated interest rate is. But luckily in this problem, the market rate is equal to the stated rate. When this circumstance exists, when the market rate and the stated rate are the same, the bond is said to be issued at face value. What is face value? Remember the amount printed on that bond. In front of the bond, it states amount. You can think of it as the principal of that bond, right? That is considered face value. The face value in this problem was $500,000. Therefore, the bond cash proceeds were $500,000. Because the market rate was equal to the stated rate. Now, what if this was changed, right? If instead the market demanded a higher rate than what the stated rate was, the bond would have been issued at a discount. If the opposite was true, if instead the market value or the market interest rate was less than what the stated interest rate was, the bond would have been issued at a premium. But in our example, the market and the stated were the same, so it issues at face value. The second part of the problem asks us to journalize the transaction for issuing the bond. So it says prepare the journal entry to record the bond issuance. In this step, we simply need to debit cash for the amount received, which were the cash proceeds. That was our first step to calculate that, which is the $500,000, and we credit bonds payable, which is a liability, $500,000. Again, we've dealt with a couple problems dealing with the actual price of the bond and what that might look like on the financial statements. That would have been in the homework problem set for the first one for chapter 10. But in this one, we're actually journalizing the transaction. So this brings us to the point of why it is that we're even talking about bonds. Bonds represent a liability. They're a way of financing operations, right? You issue a bond and you get cash, and you can use that cash to invest in other physical assets or something like that, or other investments where you earn a greater return, hopefully, than what it is that you're paying out in interest for that bond. So this is a liability, and that's why we're talking about it. So in terms of effects on the accounting equation, a credit to a bonds payable increases liabilities, and a debit to cash increases the asset. Requirement number 3. Requirement number 3 says, prepare the journal entry to record the interest payment on December 31st, 2013, assuming no interest has been accrued earlier in the year. In this example, we had a face value of 500, and we had an interest rate, the stated interest rate, of 10%. So the market had to be 10% as well because they're equal. So we multiply that out times 10%. Remember, right now what I'm doing is our interest calculation, and our interest calculation is principal times our rate times our time, right? That's our interest calculation. So multiply these guys out, and then when we think about this, I'm gonna move this so I have a little bit of room here. When we think about this, right, our transaction happened on 1/1/2013. Our accrual is 12/31/2013. The interest rate is a yearly interest rate, like we talked about. Unless told otherwise, this is an annual or yearly interest rate. Therefore, if we multiply by time, it would simply be 12/12 or 1, so it's still going to be the same amount, right? Now, if we did not issue on 1/1/2013, instead it was 2/1/2013, right? We'd have 11/12, or we'd have some lesser fraction of a full year, right? So once we have our amount here, since it's just 1 times the 50, we debit interest expense because we've incurred an expense, and we credit, in this instance, cash. Now, it could have been interest payable. That would have been a liability as well. But it's cash in this instance. Why? They tell us at the end of the problem that the bonds pay interest once per year on December 31st, and we are journalizing on December 31st. So drop these numbers in right here, and interest expense is an expense account. Increases expense, decreases stockholders' equity. Credit to cash decreases assets, okay? This is the basic transactions for recording a bond. We'll deal with later on when we talk about bond amortization tables, the reduction of discounts, what we call the amortization of discounts or the amortization or reduction of premiums. But because this bond issued at face value, we don't have a discount or premium to deal with, okay? If you have any questions about E10-7, please feel free to let me know.